This conference will now be recorded.
All right, everybody, the clock has struck 12, so it's time to begin our webinar. I'm Ray Olmo. I know a lot of you, CEO and President of TRUST-CFO. Thank you again for attending this continuing education webinar. As a reminder for our CPA and attorney partners, we're approved for CPE and CLE credits. If you need those credits and certificates, please reach out to us and we'll have Derek Smith send you over a copy. Today, what we're going to do is we're going to follow up in the second of a series where we're going to look at the private retirement plan. And if some of you were on last month's, we went over some of the cores. We call it the secrets to PRPs. And we went over some of the core underlying foundations and concepts. And so now what we're going to do is we're going to pick on each specific asset as it's important to our clients. And we're going to look at how those assets interface and work with private retirement plans and how these assets can be enhanced and bettered for our clients. We're starting really at the top. If you've looked at our diagnostic, you see that we've taken an approach of really the weakest assets all the way down to the strongest assets. And it's how an attacking creditor might come in and look at one's balance sheet and try to dismantle. And where we're going to start today is we're going to start with life insurance. And life insurance is an interesting asset class. It's a liquid class. It's right up there with checking and savings accounts in terms of liquidity exposure. And it also is something that everybody has. So again, we're going to tackle this today. Next month, we're going to look at real estate and continue on with business interests and other great assets. So hopefully you continue to learn on. We're referencing this as our private retirement life service mark and PRP. We also reference it as PRP life. So jumping into this, I'm going to again reference that we have an hour. I value the content more because I'm finding that questions tend to trickle in usually after the presentation. People tend to drop off. So again, we'll take a few questions and when it's appropriate or if it's appropriate. And moving forward, in the interest of time, is let's talk about this anomaly called life insurance. It's a little bit mind-blowing when I'm talking to every agent out there, every investment guy, and we're doing a diagnostic, and they literally say life insurance isn't protected, and no, not in California, it's not. And as a reminder, every state has its own exemption rules. California is an extremely complex animal. It has two systems: bankruptcy, non-bankruptcy. And again, it just depends on what a client is dealing with and how they file and are awarded these exemptions. But in general, life insurance is not an exempt asset in California. The cash values are kind of blow your hair back. They're only exempt up to $13,975. Every year, every 3 years, California indexes and upgrades its exemption numbers, and so this year it's been updated $13,975. The luxury is they also have incorporated a portability act, and so with a spouse you get a double up on this type of exemption. So you have a whopping $27,950 of cash values exempt or protected. Now, I know most of you on the phone, and I know my client base. And that does nothing. I mean, I have clients with multi-millions of dollars of cash values, and probably a good bulk of them with hundreds of thousands of dollars in cash values. So before they met us, they didn't understand that these things were exposed. And again, it's our job to educate them. So for, again, our attorney partners and CPA partners, I know you do the best, but please, let's use this tool now, this recording, and go and send this out to our network and make sure that these guys know this stuff, because clients have a disservice when they're not being told this, yet people are selling them these products. Let's reference the other side of life insurance, which we talked about cash values, lifetime benefit, but let's talk about now the ultimate need, which is life insurance set up for death benefits. And again, in California, it's just a strange anomaly where they don't even give a number, but the death benefits are actually categorized in a non-bankruptcy situation as determined as to need by a judge. Now, that's a scary proposition, and everybody I know says, well, I don't want to put my finances in somebody else's hand to determine if I need it. So again, it's a reality check here that everybody needs to know. the bottom line is, if you look at that, it is an asset class that, unlike other states, okay, Texas, Florida, things like that, where life insurance does have exemptions, full exemptions, it can be seized and foreclosed on like any cash or liquid asset, okay? It can actually be liened. So these are things that you do not want your client to experience, and you do not want to, you know, have your client ever come and say, well, you never told me this. So those are the facts, and that's, again, the myth is, oh, everybody seems to think it's a protected asset. So what we're going to do is we're going to look at how a private retirement plan can come into play and help extenuate or strengthen these retirement exemptions. So we're going to refresher on private retirement plans, or the PRP. And just as a reminder, again, we're going to reference this every time we talk about it, is that it's under California Exemption Statute, Code of Civil Procedure 704.115. It's a pretty short code. It's very explicit. It basically says, in regards to this, since 1970, all plan funds, all distributions, and all death benefits are fully exempt from creditor attachment and seizure, if you're proving that it's for retirement. So again, where do we come in? We need to prove that this asset is being properly characterized as for retirement and properly administrated. So the confluence there is often what we see is somebody says, oh, well, I meant for that, my policy to be for retirement, but you know, somebody checked the box if this is for estate planning. Well, you can't have a cake and eat it too. You better make sure that you're memorializing everything. And TRUST-CFO gets pretty down and dirty with this. I mean, you know, if we're funding an existing policy, we're basically filling out new remarks in a change of ownership form saying the client's claiming their exemption rights, and this is absolutely being, you know, an exempt asset under the code. So there's some gory details that you want to memorialize on this sort of thing. Now, again, let's recap the value of private retirement plans, and as it relates to PRP Life, is we view it as one of the strongest and most profitable forms of asset protection, aside from a qualified plan, you know, under federal law. Is a private retirement plan is your bare minimum need to protect your wealth for your future. And again, as long as you properly set it up, it becomes the safest, becomes the strongest, because you're not transferring assets, you're funding assets, and you're characterizing them for retirement. And that falls under exemption, not transfer law. Just again, a recap on that. It is the only retirement plan that tactically harvests all forms of taxation. Remember, private retirement plan is a tax neutral plan or trust, meaning the funding that goes into it is not deductible, and the funding that comes out of it is not taxable. What's happening is it's tax neutral, and it's allowing the assets that inherently have awesome tax benefits already, such as life insurance and real estate, that, you know, have capital gains treatment and depreciation and exchange privileges and all these things. And again, back to life insurance is, you know, tax deferred growth, tax-free benefits. Those things can still be harvested. We're also going to remind people later about the accelerator, which allows to create additional deductions inside a private retirement plan. Another item is that it's the only plan that leverages banking, liens, and loans, meaning it's allowing for special financing. So we're going to talk about premium financing as it relates to PRP. Again, the difference there is you can't do that with other types of plan structures like IRAs and qualified plans. You can't pledge them as collateral. So here's the real facts, okay? You have to ask yourself a question. Well, wait a second. If life insurance is not protected, but almost all life insurance policies are being sold and promoted for supplemental retirement needs. That's 85%. Those are stats from the insurance companies. We get them from, you know, our contacts there. Is why then wouldn't somebody want to protect that? And then, you know, when I'm in an airplane flying down Orange County and I'm looking out, I'm saying everybody's got one of these policies, but no one knows that they can protect it. It's mind-blowing. So again, let's reference what we're talking about. The policies are being sold because they're accumulating cash value on a deferred basis. Okay, some people use the term tax-free. I don't really prefer that because it just depends. And of course, there can be some whiplash or damage if you don't structure these things right, you know, and you can lose that tax-free privilege. We're also talking about benefit distributions. These are often done via policy loans, which are non-taxable and supported by the policy, again, only if done correctly. So that's one thing that the agents out there are promoting, the licensed agents. Hey, go and supplement your retirement. So again, they've identified that the qualified plans and the IRAs and the legitimate base level retirement plans are not going to solve their clients' needs, okay, which is most Americans, but specifically in California, probably all Californians are not going to be able to substantiate their future lifestyle. So again, the insurance industry has basically said, well, we can fulfill that. But all they're doing is going and explaining, they do a great job on explaining how products work, but they're not telling them that the assets are exposed. The other thing that's very scary, and I've had some really high-end executives come to my office and CEOs from Fortune companies, and when I told them, yeah, by the way, your life insurance is not protected, and they're talking about like $10-20 million death benefit policies, they just almost fall off their stool. It's like, well, wait a second. It's one thing that you can try to sue me for my real estate and other assets, but now if something happens to me, you tell me that my wife and kids could lose that, and that we actually have stories that has actually happened. So at any rate, it's kind of a scary proposition. So again, something we want to attend to. The last thing is that now you have these other lifetime benefits called accelerated benefits or long-term care, chronic illness, depending on the type of policy that's structured. And what we've done is we've identified this. I've got a buddy of mine on here, Barry Bosco, and Barry's really into this. Barry's brought up that, hey, these are things that we should have built in. And what we did is we actually have formulated in some provisions in there. So upon disability, that becomes a distribution event, and the policy can help substantiate the cash flows for that. So at any rate, again, you're attending to any of the benefits that the life insurance policy can then provide to our valued clients. The bottom line is if we structure this properly in a PRP Life plan, all benefits can be exempt from creditor claim and seizure. So that's our goal there. Okay, so the bottom line visually is this is what something looks like in terms of an accumulation and a distribution model to mortality, and then a lifestyle for the heirs on the death benefits. And basically, it shows that there's a lot of money that's being accumulated and spent down, but the whole way you're exposed, and so that can be dangerous. Now, I realize that there's some planning that goes on, and there's some policies that are in ILETs. What I'm referencing is policies that the agents sell that don't understand advanced planning, and the client owns it in their own name, and that's going to be a tragedy. Okay, we can make this puzzle look like this, where we have both cash values during lifetime and death benefits for surviving heirs be exempt for against creditor attachment. So that's what we want to look like. Okay, so what I'm going to cover is I'm going to cover the sales strategies that we apply on a regular basis in almost every case. Again, barring somebody that can't qualify, or again, I should probably say that if an agent or the planning with an advisor has been directed towards another need, like a buy-sell agreement, okay, or a deferred comp plan or something like that, you can't double dip. You can't say, well, I want the policy to be for retirement, but also solve a business liquidity need. So again, if it's a buy-sell policy, it's a buy-sell policy. That means that it could theoretically be exposed if you're not doing advanced planning correctly. Again, a lot of the attorneys I'm looking at that are on right now are pretty good at making sure that they have that protection. So back to the retirement schematic is what we want to look at is, I'm going to set the foundation for the base planning first. Okay, it's the funding of the life policy and how it goes into the policy. Then what we want to do is we want to overlay the concepts that we reviewed in our secrets to PRPs before, which is some advanced planning. These models, and again, these basic tools, were about creating cash flow for our clients. One of the #1 hurdles that every life agent has ever had in the 30 years I've been in business is, well, I don't have the money, or more importantly, you know what? I have the money, I just don't want to put it in a life policy. I think I can get a better rate of return in another asset, usually something like real estate or my business. So it competes with those dollars. So I'm going to show you the models that we use to really open up those doors and create the funding opportunities so that we can solve our clients' problem without disrupting their world. And that's going to include #1, the promissory note, who again, most of you that we've worked with have experience in, the PRP accelerator on the same account. And then lastly, I am going to tap into the concept of premium financing, which has, of course, been violently hot in the last 15 years to 20 years. in terms of solving cash flow problems. So we're going to look at that. Okay, so let's jump into the base level planning of a life policy and how to get that into a private retirement plan. Again, we always work on their visual models and allow our clients to understand how the inner workings of the puzzle. So a client hires TRUST-CFO and says, hey, we'd like to administrate a plan, a private retirement plan. And then we're going to set up the plan, and then the trust gets set up for the participant on behalf of them that's going to own and exempt those assets on behalf of the plan. So what the client's going to do is they're going to take their after-tax earnings. Now remember, again, when you're funding a private retirement plan, you're not deducting the contributions. So these are after-tax dollars that have already been charged and put on their balance sheet. So they make those contributions on a regular basis. Now, you're going to find that there's a lot of clients who say, hey, just every year when I make whatever, $500,000, I was literally on the phone with somebody early this morning and go, hey, we have an increase in income from a new job. We're going to make $500,000 per year or more. We want to make sure that every year we only spend what we need and pay our taxes, and the rest we can be stocked away into for the rainy day fund, meaning our retirement. And that's the number that we come up with to help fund this plan on an annual basis. So when those monies come in, now the trust owns those monies, those dollars are exempt, but then the trust has to invest in something. Well, again, a client can pick and choose what they want. They could say, well, listen, I'm big on real estate. I want to go and allocate that to real estate. I want to go put it in LLC and buy a new private equity deal, whatever they want. But a lot of times they basically say, well, Ray, what do you suggest? Well, we have to talk about, things like taxation. So whatever you put in the private retirement trust, it's neutral, so it's going to flow through to the client just as if they had owned it. So like on a 1099 on an investment account. So again, just like you would in a deferred compensation plan that also has that neutrality and it's charged to the participant, well, why wouldn't we put it in a life policy that's tax deferred on the cash values, accumulates tax deferred, so the client doesn't pick up that income and they can compound their values. They can get those tax-free, if again, properly designed policy loan benefits. Then of course they get a tax-free death benefit. And so again, that tends to entice a client, or at least an option as a part of a whole. So again, we don't put everything in it, but depending on how much cash flow is going in there, they tend to like this as an option. It's our obligation to share it with them, right? So the key to the strategy is something interesting. And when I first got into this, during the crash, the 06 through 09, as most of you know, I was looking at this from a deferred comp standpoint, and I was saying, okay, yeah, the thing I don't like is I don't want to put money into a plan or trust and then have a client say, well, it's in there, I funded it because I needed to prove I'm funding it, but then I want to take it out and go do something with it. The problem with that is what happens is that money then comes out of the plan or the trust. And with the optics, that does not look good. So now what you're saying is, well, wait a second. I put in $1, but then I take the $1 out, and yeah, I have the $1 working, but whether it's a trust loan. But the problem is the trust doesn't have it. It has it in the form of the loan. What I like about the life policy, if most of you understand, things like the IUL chassis, and we can either structure it with a whole life chassis, is basically the variable loans, which is the money's not leaving the policy. So when we do the reporting every year, the annual reporting, the financials, we book it. And the life insurance policy is a little bit more of a complex model. We're showing the values, we're showing loans, we're showing net values, but the money's in there, and with the loan, it's held against it. So a life policy has a double booking. It has the asset values that show that it's in the plan and trust, and then we have the loan value that's being offered from the index policy, which is actually out of the general corpus of the insurance company. So again, optically, I really like that type of model. Now, again, we don't want our clients to be abusive, so we have some requirements. We don't let them borrow the money immediately. We like them to season the money so they can't take out the monies they put in the given year. We want the trust loan interest to match the policy rate or higher. So again, what's happening is you're not just borrowing from the policy, the trust and the trustee is borrowing from the policy, and then the trust makes a trust loan, okay? And that matches that and then sends it off so that the client can invest in their business cash flows, down payments on new asset purchases, again, like real estate. And then, of course, as always, we place liens on those assets via the plan and the trust. what's happened is basically the cash flows are being reinforced by the policy on a tax preferred basis, but we're doing it really through the trust modeling. Okay, the ultimate thing is we can't ever forget that all this has to be done and memorialized so that we're doing it for retirement. So every time we're making a trust loan, we're proving up that, hey, we're not just loaning that money so they can go buy their yacht and sail on it. No, we've decided that it's a good investment to make that investment is now a loan that's getting interest, and it's investing in a great assets that's growing faster than the values of the insurance policy. So that's what the arbitrage is about. So that's the core model of how to fund a life policy into a PRP and the working components. And again, there's some depth to that in terms of administration that we as a firm provide. Again, what I suggest is that we work through an actual policy structure and show the clients the models, and using those the illustrations, and then fortifying and showing the weaknesses in a lot of illustrations. Okay, so that again is our core or our baseline for funding the policy. Now what we're going to get into is, well, that sounds great, but business owners, and real estate guys are real estate guys, and again, every life agent has dealt with, I think I can do a better job. And we're going to say, well, really, can you? Let's show you maybe how you can't, or maybe you shouldn't. So what I'm going to do is get into the advanced planning program. Actually, before I do that, I'm sorry, I forgot. I want to disclose that we have our plan program fees posted on our website. We want to be transparent with that. In the PRP Life program, it's actually held in a cash side, so it's low. And what we're doing is we're allowing our clients to fund cash assets, cash proceeds. Annuities are even included in life insurance. Reminding you in advance that all the fees are fully deductible, so you need to look at it from a net cost standpoint. So our charge is, we have for PRP Life program, for if it's just life insurance or cash, it's $2,500 one-time setup. That includes all the fees for the plan and trust setup. It's a simplified version because it's not dealing with complex assets. And annually, we're charging $2,500 to administrate that in totality. Okay, that includes all the reporting and trustee fees. Now, again, at the end of the day, that's deductible. So if a client is paying net $1,250 at a 50% tax rate every year, aka $100 a month, and they're protecting hundreds of thousands of dollars in cash value and millions of dollars in death benefit, it should be a very strong proposition. We do have the caveat that this assumes that there's no other assets in there and there's no other risk exposure. If the more complex assets a client decides to fund, then we have to raise the bar on the plan program and make sure we're accommodating, because there's a lot of extra work to do that. Managing a business or administrating business is a heck of a lot more intense than managing a life policy. Okay, so again, my apologies for a little sidebar there, but I did want to disclose that. Now I'm going to hop into our 3 advanced planning tactics. The promissory note. If you who attended before remember, the promissory note is the way for us to monetize the future funding from a client. So they're going to have current funding, but then they're going to have future funding. And again, where most people missed out is they only funded current assets, and they didn't think about all the wealth that the client's going to be building on their earned income between now and retirement. So what we're doing is we're capturing that, and we're actually creating this pre-committed capital. So with life insurance, it becomes pre-committed capital. Again, if we're talking about a life insurance agent, they're saying, well, can you write a check for $50,000 every year between now and age 65 to fund your plan? And the client's sitting there going, yeah, I think I can. But again, in a promissory note, it's a full-blown commitment. They are saying, I am intending to do this, a lot like a defined benefit plan. So it's a stronger level of commitment, in my opinion. So again, to our modeling, what we're going to do is the client's going to have TRUST-CFO decide what's going to be funded, and then calculate what the value of that promissory note is. I'll use an example, but the value of the future funding stream. So again, if it was $100,000 per year over 10 years, that's $1 million of funding that we're anticipating that's going to be committed in the form of a note. So that client then funds that note. Okay, they're going to put in that $1 million promise to pay, and every year they're going to fund that $100,000 check to meet that note payment. Okay, but the promissory note, don't forget, one of the tricks here is the promissory note is an unfunded asset. So what we need to do is equate the balance sheet of the trust. And what the note does is says, well, great, we know you're good for it, Mr. Client, you committed to it, but until such time as it's funded, we're going to place a friendly lien and protect other non-PRP assets, equity in houses, cabins. I've got everything under the sun lien, cattle, CPAs, accounts receivables, which is their most valuable stream. You name it, we've covered it. And so at the end of the day, those are assets now when they're liens that have transferred on the balance sheet. Now, you got to remember, guys, this is kind of a cool trick here. The client is voluntarily saying, no, that's a good thing. So by virtue of the PRP, we've just convinced the client, justifiably so, that this is a good thing because you're now protecting your assets for your retirement, and we now have those secured. And they are now volunteering to do that because there is a value and benefit to them that the life insurance by itself doesn't provide. So again, what am I trying to do? I'm trying to create and provide what the benefits of one side, like a PRP and a life insurance policy, do to help accentuate the the potential downfalls or risks of the other side. So they complement each other. And as we remind our clients, every year is that, hey, don't forget, you have to service that note. Okay, and so what that means is your promissory note is an asset of the plan. It has to have a growth rate. So by virtue of that growth rate, that's represented by annual interest payments. So if we say, well, the promissory note needs to grow at the plan rate of 5%, and it's on $1 million note, then every year the client needs to put in $50,000 of additional interest payments. Is that a bad thing? Not in my view, because now what we're doing is we're capturing and protecting the after-tax earnings from a client that they should be wanting to protect anyways. So it helps accentuate future value and protect future value. But now what we've done is we've got these annual promissory note interest payments in the bucket. And what are we going to do? We're going to go back to our base level model and say, hey, you know what? Here's some options. We could reallocate those contributions and we can fund a PRP life policy, and you can grow tax deferred, tax-free death benefits, and tax-free index loans, as we discussed. Back to the death benefit, one of the cool things is we've actually created a new need for the death benefit. Because we bought the life insurance policy, the death benefit, okay, is now going to secure and pay off the promissory note obligation. So in this case, again, using my example of $1 million promissory note, $1 million death benefit would come in if the client is predeceased and couldn't pay off that note, meaning they couldn't fund their retirement. And therefore, that death benefit now self-fulfills that retirement obligation. The $1 million comes into the the private retirement plan, and that is used as a beneficiary designation to provide tax-free benefits, exempt from creditors, to the surviving heirs and spouse. Okay, spouse, heirs, revocable living trust, whoever the beneficiary is. So again, I view it as a really self-fulfilling model, and in a vacuum creating its own need. Again, lest we not forget, always have to justify everything as this is being done for retirement, and then everything is strong and safe. So that's our promissory note model. Here's again, I used this on the last one. I didn't want to have to recreate. This is a case we did 2 months ago. It's a great little model. Some people that, again, really were massively short in the retirement. We funded a promissory note of $2.5 million. The annual interest rate at 5% is $129,000 going in per year. And at the end of the day, that $129,000, they agreed, well, hey, we need insurance anyways, and we like this model, and it supplements everything we're doing. So win-win-win. That promissory note payment of $129,000 over 17 years is $2.2 million going in. And then the life policy illustrations supporting, all the distribution or growth, all the annual distributions at the retirement and the total retirement benefits, all compounding, and then throwing in the death benefit, all exempt. So again, what I'm doing is I'm creating, taking $2.2 million and protecting it and exempting it, and then parlaying that into $20 million worth of overall benefits. If they decide to use the arbitrage, which our game plan with them is, because they're investing in some very well consistent mobile home, parks. That parlays a little bit further into another $6 million. And so we're really leveraging those policy loans. Again, reminding you, we're not taking them out year one. We're making sure that enough values are in the policy to substantiate and protect the death or the cost of insurance and the fees over that accumulation period. And so that this has to be structured right. But again, you can still get a ton of benefits out of these things without having to be aggressive. And that's what I think these two animals do for each other. So in recap, again, the capital has already been committed for funding period over time, and it's usually a 7 to 15-year period, with the clients that tend to gravitate to this. So we're actually really able to design and mirror it to the life policy funding period and make sure that we're really aligning those two together. It is the only option that leverages the same dollars. So again, going back to that, if somebody says, well, I don't want to do that, I have my life insurance over here, I'm going to go ahead and fund the promissory note and invest it in something different, guess what? They have to spend $2. They're going to go and pay the promissory note, invest it in something, again, let's pick like real estate, but then they have to still write the premium payments on their life insurance policy. So they're out $2. So by combining the promissory note with the life insurance policy owned by the trust, we use the same dollar. So when a client writes the check for the promissory note payment, that validates the note. We're great there, but the trust owns the policy, and then it takes those premium, those contributions, and pays the life premium with the same dollars. So again, you're really showing your client how to manage the cash flow and stretch those dollars and get multiple benefits. So I really love that concept. Lastly, the death benefit supports a key need of paying off the promissory note in a vacuum. Again, what we're doing, we're self-fulfilling the obligation of retirement that a client wouldn't make if they predecease. So that is our promissory note, and I'm going to again take questions at the end, but we need to jump into round two. The PRP accelerator, because again, we're still after solving various different problems. The goal here is to maximize our PRP cash flow and then allow our clients to use some of those fundings, those newfound capitals for funding a life policy. Again, this tends to be, I did this one, in the 2000s, and I did the premium was $5 million. It was one of the largest of the year in the insurance industry. I think it was about 205 million of coverage. And the deal was that we want one of these policies, we need to have these things, but we don't want to have to spend the cash. How are we going to do this? It was not premium financing, it was done through this model. So the accelerator model, where a client hires TRUST-CFO, is again, if you refer back to the secrets, it's funding business interests or corporate stock, active corporate stock or LLC member interests that then drive cash flow. So now what's happening is that cash flow is now routing and being captured inside the private retirement plan and trust that is exempt. So we're protecting the business interest, the equity, the paper of the business, and then we're protecting the cash flow, the future value of the business. And so those are two important dynamics. But what we have with those dividends and distributions, again, because of the tax neutral model, is we have a problem. We still are paying the taxes, meaning the client's still losing cash flow and taxation. So you got to be careful of the tax burn here, because you've got assets getting funded to the trust and cash flow, but the taxes are being paid by the client. So it's called tax burn. Now, in the private retirement plan model, we have the ability to have the trust provide for the tax payments to help the participant. So we can neutralize that. But I got a better model. Instead, why don't we say, well, listen, as we're accumulating, and before we pay the taxes in the next year on those dividends and distributions being captured, why don't, again, we use our accelerator model and we set aside some reserves, not all of it, just some of it. And just so you know, it's going to be usually on average about 20-30% of capital, pre-tax capital, that we really can justify safely and strongly. Sometimes it's upwards of 50%, depending on the risks of the business. But that's a big bite at the apple. And what we're doing is we're saying, well, we're going to set aside some of these risk reserves. We're going to allow that to be a deduction, which the private retirement plan can, because it's vested to make sure that risk is insured. And yet we're going to say, well, the trust will take on that risk. Client, we just want you to have a minimal capital outlay and use a fraction, 10 cents on the dollar of those dollars. So what we're doing in essence is we're getting a major increase in cash flow. The reason that we're able to do that is because we have an extremely efficient financing model. It's getting better, obviously, with current rates. We have low-cost financing, 2.5 to 3.9%, depending. It's deductible, interest only, and actually we don't even take year 1. We take year 2 through 5, and there's no collateral required, so there's no disruption to the business. Again, that is a nut bottom line cash flow enhancement for our clients. So we just in a vacuum created a lot of capital for our clients to reinvest back in the business. But we don't want them to take all that because we have some obligations. We want to make sure that those future values are going to be around, and we want to substantiate and we want to justify, and we help do that and risk manage because, again, should the client not be around in the next 10, 15, or 20 years, or whenever the strategic plan is intended to culminate for retirement, then we can have some of those reserves used to purchase the tax preferred insurance using the PRP LIFE concept and get all those benefits we've already discussed. So what I want to do is I want to compare it to premium financing. What you're doing with premium financing, you're saying, let's borrow the money and let's go and have the financing company write the check for the insurance, and the client pledges capital, which we're going to discuss, and that's fine. But sometimes it works and sometimes it doesn't work, depending on the variables. And what that doesn't do is it doesn't take care of the tax. So you're not creating cash flow from the tax, you're creating from the lending. So what the accelerator model does is it actually leverages the tax deferred savings over time to compound those assets and create that cash flow. Again, don't forget retirement. That's always going to be our cure-all. Here's what this looks like. This is our accelerator model. And again, what's going to happen is, let's say the client's making $4 or $5 million taxable income, and we determine that there's the PRP is incentivized to have a risk of savings or deduction of $2 million, which is above the line against all tax forms deduction under 162. And if they're at our high rate, which they will be at that point, they're saving $1 million, $60,000 per year in cash flow. Okay, they only have to come up with $200,000 or 10% of the risk premium. And so what they're doing is they're taking that difference and they're compounding it at a low interest rate, the deductible rate, and they're growing it in their business and they're accumulating value. So what happens is that we have this reset button we built in every 5 years that they can fund this, get the deduction, compound wealth, and then at the end of 5 years, choose to pay the tax because it's been deferred, or punt it down the line saying, no, we're actually still in business, we still have risk, let's go do it another 5 years. And so what you're doing is you have this compounding model and then electing every 5 years whether to pay that tax. Again, I remind you in our secrets, we tactically always try to chop away at that tax through other tax planning like depreciation, tax credits, offsets, and things of that nature. So we're usually pretty good with our power partners, our tax partners, to mitigate that $1,060,000 that tends to resurface every 5 years. So again, cash flow is king. What we're doing is saying, well, out of that, $1,060,000, how much of that should we have go fund a PRP LIFE program? And that's something that we come up to, and we determine what the benefits need to be. So in recap, what we're doing is we're using business profits and the tax savings to build a PRP corpus and values. We're creating those large tax deductions to improve the cash flows. And then we're leveraging the life policy to secure the tax preferred benefits. So it becomes like this kind of, almost a deferred comp model, but that, again, the reason that most of the Fortune companies use life insurance in deferred comp is because it's taxable and they know it's more preferential net when they can compound that growth in the model. So that's really no secret sauce. Okay, I know I'm moving, but seem to be good on time. Let's look at our last advanced platform or program that we tend to work on, and that has to do with premium financing. Again, the premium financing is pretty well accepted. There's a lot of people doing it nowadays. There's a lot of platforms and doing it. And my contribution is I come up to it from a banking standpoint of that, just like other things, is when you go to a business owner and you say, hey, listen, why don't we go finance this asset? But you're financing something other than their key asset, business or real estate that they live off of and they know and they want in there. And then you're saying, by the way, to get this solution, we have to lien and we have to encumber and collateralize certain other assets. You run into a brick wall. And so I'm very familiar with the struggles of the premium financing industry. It's a great proposition, but you're going to have to deal with the owner's need to keep capital working in what they like, not in what you like. So again, just to, call a spade a spade. So what I'm going to share with you is a couple of ways to enhance and improve the premium financing results using an exempt trust. So in the premium financing model, what we're going to do is have the client again say, TRUST-CFO and referring advisors here, we want to set up one of these private retirement plans and trusts, and we have a lot of assets that are going to go into this bucket. So what's going to happen with the private retirement plan is it's going to have private assets, just like we discussed. Private equity, real estate, and LLCs, business interests, all the cash flows relating to that, meaning the future values of those assets. And then again, let's not forget about that promissory note. And let me remind you of that promissory note, because that also has already prematurely secured the balance sheet on the other side because the client has committed that. So what we have in the PRP is we really have all the assets that we need into the bucket to service a premium financing model without having to encroach in on the credit capacity of the client's other assets. So again, that promissory note becomes strong because with our relationships, we're able to use it as additional collateral because we can cross collateralize that note because it has liens on those other assets. And it can, unlike certain banking models, we are able to pledge those from the promissory note of the private retirement plan over to any type of financing arrangement, whether it's me financing for the accelerator concept or financing for premium financing. And so that's what the cash flows also are what you use to make the interest payments. So interestingly enough, the promissory note annual payments that come in, if they weren't being used to already fund a private retirement life program, then what it could do is could be used for the financing of the PRP life program. A lot of you guys know Jeff Verdon. He's very good at this. Jeff's a big proponent of this, and he knows the inner workings and hidden mechanisms, and I tip my hat to him on that. So again, interesting model, kind of already built in. We already have the other non-PRP assets protected, volunteered by the client, because we're actually providing a benefit for it, other than just purely encumbering it. And then we get into the financing models, and we're only using the PRP as the assets, using the note, and we're not requiring any additional collateral. So there's no disruption to the business or investments. So again, if you're able to say, I now have an exempt trust that already has these pre-built-in things, then you don't need to overreach. And I've been in banking, I've sat on boards before in loan committees, and I've caught the big banks doing major overreaching. Some of the biggest names and saying, wait a second, your agreement says that you'll collateralize up to 130%, and you have your client collateralize up to 180%. You're overreaching by 50%, and your client doesn't even know it. And I'm willing to call them on it. So this is a way to keep everybody honest on the value of the assets against the value of the financing. Okay, last thing again, what that does is then now instead of the private retirement plan writing the check for the premiums, you're financing the premiums and leveraging it, and tend to get more numbers, larger numbers, to solve bigger problems with that. Again, this is all devised for retirement benefits. There are some models with this that have to deal with how to get the insurance outside the estate. That's above the pay grade on this presentation. I'll probably do that one in a few upcoming series. But again, right now in the pure sense of just providing lifetime retirement benefits, this is our pure model. Okay, so in recap of the premium financing, what we're trying to do is enhance the capital efficiency and only use the PRP plan trust as the working capital to solve the problem. Leverage the P note for gap collateral, so we're not invading the credit capacity of the business or investment assets. And then using the plan values above the premium financing loan is fully protected from loss of creditors. Let's go back to the creditor exemption. One of the problems with premium financing is, unless you're dealing with an ILET, that if you're doing a regular policy, what happens is the premium financing loan goes down over time, usually about a 10-year period or so. The values of the policy go up, and now that gap of equity is exposed, just like a mortgage. So at the end of the day, if your mortgage loan goes down and your equity or the value of your house goes up, you're creating a huge discrepancy, and that's all exposed to creditors. So what we're doing is, by virtue of the exempt trust, we fill that void so that in 10 years, we don't have an exposed policy. That yes, maybe it's paid off, the premium financing is paid off, and now they have a ton of cash flow or cash value and a ton of death benefit, but now those things are exempt because it's inside the plan and trust. So hopefully you all appreciate that. So let's talk about, as I always want to recap, how do we cultivate profitable PRP business? And the numbers are this. The optimal client is going to be our $5 to $50 million net worth range. We just got a diagnostic in this morning for $62 million net worth. Exciting times. So guys, there are a lot of people out there in very high demand and are ready to do business. But this is really the sweet spot. I think I've mentioned this before, this $25 to $30 million range. They've outgrown their advisors. They've broken through the ceiling. They have a whole new set of risks. They can't sleep at night. Forgetting the epidemic right now or the pandemic, it's just inherent business risk, and these models work. We want $500,000 more in earned income, and typically the sweet spot is we want about a 10 to 15, maybe even 20-year horizon, and that's typically our 35 to 40, or excuse me, 55 age range, where we can really compound the values. Please leverage us as your ultimate backroom office resource. I can't stress enough that while I just went over these models, they're basic models. At every turn, there is a T to cross and an I to dot in terms of how do you get the administration done properly and not unwind the beast. Because if you slip up and you don't have something documented and you don't have a resolution on an LLC that's owned by the exempt trust, you got a problem and you got a hole where the bad guys can slip in. And if you'd probably be sick if you looked at our checklist of all the to-dos at each level. It's probably, I don't know, 200 items long. At the end of the day, we just have to scrub through it and make sure each one of those things all those holes are being plugged properly. Always start with the diagnostic calculator. We don't take in a case, unless it has the diagnostic. If you're one of our power partners, we can private label that for you and let you take ownership. So again, that's our process. Okay, I try to, again, squeeze in a lot into an hour, but everybody's time is valuable, and as is mine, and I want to make sure that we can go ahead and look at some questions. I got a couple here. Is Josh Meyer, my buddy. Hey, Josh. Meyer Law Firm down in Newport Beach. Josh does a lot of this stuff. Let me read it. Ray, with our PRP cases you've consulted on, you've requested that the referring advisor structure a policy a certain way before loans can be made. Can you explain that in more detail? Yeah, I did broach that, Josh, and you are savvy to that, is the clients always push to, I want to put money in, I want to take money out. You do not want to have the same dollars in the same year going in and out of the plan. You want to season them, and then they re-characterize and they take a different shape in the form of a trust loan that is then supported by the life policy. So typically, in those policies, we're going to often max fund, we're going to reach a MEC ceiling, we're going to have a lot of capital, and then year two, when the premium funding comes in, then year one can be borrowed. But we track all that, and we make sure that there's always enough fodder in the cannon to make sure that it can support itself through at least the plan term that we're looking for. So that's important. Again, if a client says, well, they have to fill out a loan request form. I want a loan. What's it for? It's for growing a great business with a great rate of return. Great. Send us, the shareholder agreement, the operating agreement. We can make those loans if they're justifiable. We don't make them for lifetime expenditures. Okay. Barry, can an annuity be placed in the PRP instead of life insurance? Yeah, absolutely. An annuity is great. We'll probably add that to a form. an annuity is a retirement asset. You know, Jay Atkinson, friend of mine, you know, is a big proponent of annuities should be placed in there to meet that ongoing funding. You know, absolutely annuities, and I like annuities in the chassis because they also provide some of those lifetime benefits for those you know, those disability distribution benefits. And then what about term policies? This is another question. Term policy in a buy-sell agreement, can they be put in a PRP? Yeah, again, I don't like to try to split hairs and claim. Imagine this, imagine an attacker coming in and saying, well, you bought this term policy, it's for a cross-sell buy, you know, or a cross-purchase buy-sell plan, but you're trying to say it's for buy-sell for business purposes, but then it's also for retirement. That gets a little hinky, meaning, am I going to try to say, well, the buy-sell is to buy out the partner, and then it's for the retirement of the partner? Theoretically, yeah, but it gets a little messy. So the answer to that is, I mean, you're talking about term policies. What you probably do is buy a term policy for buy-sell and buy a term policy for your surviving spouse inside the private retirement plan. That's probably the safer way to go. And I think I could convince a client that makes good sense. Let's see, I don't see another question. Any of our new hotshot power partner attorneys online? I see any questions from you guys? Again, I know most of the questions come in after the fact, and I appreciate that. And they usually come in through case analysis of, you know, they get submitted. But again, we're going to have this posted online for your regurgitation. Yeah, we do have one more question. How do you put investments account into the trust? Okay. All right. Here's what we've come to realize. You can put investments into the trust, but when you do that, now what you have to do is the trust owns the investments. The trustee is taking in a lot of, you know, risk in terms of them now playing the investment advisor, even though we have a trust advisor in there to help with that. But now you got a third party like a JP Morgan or Merrill Lynch guy coming in, and what I've discovered is that while we want to help them, they don't understand trust, and they seem to always put us at risk because what they're doing is they want to invest based on their portfolio protocol, not the plans. So when we say, hey, we're trying to, it's like a defined benefit plan. We're trying to meet an objective of meet a 5.5% goal, and this is the way we need the investment portfolio structured. And they're trying to design it based on how their home office is telling them to design it, and it often conflicts with that. So the long answer to your question is, what we have found is if a client doesn't mesh up, or they want to do something and have a different portfolio strategy that doesn't match with the plan, then what they need to do is set up an LLC asset management entity. I was speaking to one of our new partners, Brad Barth, yesterday on a case. I said, Brad, is this better for them to set up, you guys set up an LLC as an asset management company? They can act as the co-managers, they can hire their investment guys, they can go and build it in the LLC, but the private retirement plan will be the member and own the assets for the LLC, and then we can accommodate the plan benefits through that LLC distributions. So again, there's kind of a different way to think three-dimensionally on this stuff, but the LLC is just, like I put in secrets, the secrets of PRPs, it's just a great asset management tool. You know, it really is well aligned for a private retirement plan. All right, well, my friends, we're you know, a few minutes away. I don't see any more questions. We'll entertain those offline. And again, we would like to thank everybody for participating. Hopefully you find this valuable. I got thick skin. You know, if there's anything I can do to improve this, other than probably talk slower. But again, we tend to find that there's a lot of content to stuff into this. So I'd like to get it in, and then, you know, then we can tackle all the details later. So my best to all of you. I hope you and your families are safe, and everybody is starting to, you know, get excited about trying to get back to the real world. I know I am. So I look forward to chatting with each of you here soon. Have a wonderful day, a wonderful week, and we will look forward to our collaboration together. Take care.